Welcome to the President and CEO Focus on the Middle Market podcast series, where President and CEO founder Paul Stukel discusses middle market issues with business leaders from across the nation. Today, Paul speaks with Phil Isom, head of KPMG Corporate Finance LLC, about KPMG's recent survey on the prospects for middle market M&A in 2014.
I hate to say it, but I tend to chuckle every time I ask this question these days about the middle market M&A world beginning to take off, because it seems as if it has been predicted for several years now. I mean, again, with good reason. I mean, you think about it in terms of the demographics of folks that are running middle market companies. They're getting to that point where transition becomes an important thing. Obviously, the interest rate environment has been pretty good. This year seems to be different. There seems to be an indication in your report that this might be the year. What are your thoughts on that?
Yeah, I think what we're seeing is right the same things that you noted, which is right the debt markets are extremely strong. So a lot of capital is available. I think a lot of companies have, as has been reported, a lot of cash on the reserves, but some of them have been on the sidelines, right, and waiting. People are waiting for whether it be the political things to sort themselves out, or the Fed, whatever the case may be. And I think our view is that the combination of kind of more clarity from the regulatory environment, the cash that's on the balance sheets, and the liquidity that's in the market, that all of those things kind of feed the opportunity for M&A activity. And I think even putting a finer point on it, what we're seeing in our transaction services practice and the corporate finance practice is the beginnings of that. Companies that are talking to us and trying to figure out right how they prepare for what's going to happen in 2014. And I think where we're seeing a lot of that is frankly on the diligence side for companies that are looking to sell and divest, but also companies that are looking to buy. The companies that are looking to sell are starting to take a look at their at what it is they're carving out, look at the financials, start to prepare themselves. And the guys that are looking to buy are starting to identify potential targets. And I can just tell you from our own workloads, it has not been a slow quarter at all. And right. as you might imagine, that can happen because of the calendar year end, but there's not a big tax law change like there was in the past.
Like last year, yeah, right.
Last year. So there's nothing you really point as what's that's the impetus. So I think it's more what we're seeing, and it's in line with our survey, which is we're seeing more activity. Companies are deciding, all right, things are getting more clear. Now's the time to figure out ways to grow, whether it be organically, inorganically, or to monetize assets that they've been holding on to and trying to find the right spot to sell. Right.
On that last point, as I understand it anyway from talking to various folks, part of you had mentioned the uncertainty, the financial uncertainty, and certainly the economic uncertainty, both here and clearly in Europe. And China's been having some hiccups of late. But the biggest inhibitor, I've been told, to more M&A activity, certainly in the middle market, has been an unrealistic expectation with respect to valuations, and particularly on the sell side. The sense that folks think their companies are worth more than buyers are willing to pay. Have you seen that? I mean, has that sort of been the experience that you've been seeing, or am I missing that completely?
I don't think that's probably something I'd point to. Clearly valuations for companies that are right in vogue and that people are desiring, valuations are up. In terms of people's expectations, I think that there are always those that are going to have poorly aligned expectations. But I think in general what we're seeing is that there's a lot of companies that are looking to sell portions of their business and are going into it with reasonable expectations. Now, all of that, and maybe this is part of it, is all of that is buoyed by kind of the liquidity in the market, especially the debt markets. I think the challenges are on the private equity side. There's a certain segment of the private equity community that is, very active on the buy side right now and looking to accumulate assets because of the great capital environment that we're in. But there are also private equity funds that are out there that are very focused on selling as much as they can because they think this is the best time to sell. Valuations are at high levels. Liquidity is at the best it's been in years. And so there are certainly an element of the private equity community that thinks, now is the time to sell and it's the right opportunity. Obviously, you got to find a willing buyer that, sees the world the same way you do. I think on the corporate side, all right, there's still probably a little more discipline in terms of their decision making. They've got a board to answer to and the like. But overall, I think the expectations are not wildly out of whack right now.
Interesting. Now, it's interesting to me that you say that valuations are up, and that. My thought would have been that the private equity guys would be the subset of those that are interested in selling would be motivated actually more by the need to liquidate, right? Their windows are closing, the 5-year windows or 7-year windows or whatever. But you're suggesting that valuations are actually pretty attractive for them. I guess what's interesting to me is that we really are sort of just coming out of some economic turbulence, as we all know, and we're coming out of it relatively slowly. I guess has that already been priced? Has it been priced in? The suggestion there is that, at least to my way of thinking, is that the recovery has been priced in. So you're basically saying, okay, it's all the valuation's got to be high because we know that we're going to be growing for the next few years, or the next 5 years, or whatever. I mean, am I oversimplifying that, or I'm just kind of confused about that.
No, I think you've got the right concept there. I think that a lot of the valuation has been priced into the market, and there's not a view that there's a huge amount of upside. Every industry is different, every fund is different, and so each deal is a different situation. But in general, my view is that the market is very receptive, it's open, and the expectations have been reasonable. It's never perfect, right? You always have buyers and sellers that can't get on the same page. But in general, I think that the environment's very strong for M&A.
Yeah, and as I understand it, the middle markets can be the hot place. I mean, the mega deals, there will always be mega deals, but I'm really thinking more about private equity. But just in general, as I understand it, that's going to be the hot place. This is going to be the hot sector.
Yes, no, and I think that goes to the liquidity that's out there. There's a lot of liquidity for the middle market companies, and then frankly, the middle market space fared pretty well through the downturn. And was a good place to put your money. So I think in general you'll continue to see the middle market space, so long as it performs like it has, you'll see it continue to be the attractive spot. It fits very nicely with obviously the private equity funds. A lot of them are focused on that space, but the liquidity is there for it. And so the just overall structures are very attractive. You can still get a good return in the middle market. It doesn't take the bite size to do the mega deal. So it's a good spot to be for private equity.
So what are the pitfalls? I mean, what are the potential pitfalls? I mean, I guess the obvious one, the economy tanks. Anything? Do you see any sort of dark clouds in 2014 that may disrupt the party, as it were?
Well, clearly everyone's got one eye on interest rates.
Yep.
Right, and that's something that has been at all-time lows and has really made a lot of transactions maybe more attractive than they would be in a different interest rate environment. It also has kept a lot of companies probably flush with liquidity that otherwise might have had to service more debt. And so you haven't seen as much activity on the distress side. So clearly interest rates is an area that everyone is focused on. I think if so long as Europe and Asia going to continue at their same pace, clearly the U.S. is the market where there's the strongest growth opportunity, and where we've seen a lot of both deal flow and money flow come into. when you look at specific sectors, for instance, healthcare, right? You're trying to figure out what's going to change on the regulatory side. Healthcare and technology have both been the most active sectors and are projected to be the most active sectors in our survey as well for 2014. Technology to a lesser extent, but certainly the regulatory side, both state and federal, on the healthcare front, will really influence what happens in that space. The bank space, same kind of thing. There's a number of regulatory issues that are coming out and coming up, and that's going to change the perspective, which way, depending on which way people are leaning.
Right. Now, I love the way you used the phrase "events in Washington." My goodness, that covers a lot of sins. I'm sorry. Yep. You had mentioned the U.S. sort of being the place, the hot space geographically. Is that so? You see in 2014 a lot of the activity that you're looking at, particularly again, I'm trying to focus on the mid-market. A lot of that activity is going to be mainly domestically focused. Is there going to be? Do you see any sort of major perturbations in cross-border transactions?
We have a KPMG through all of our various country practices. There's a huge investment banking practice, so there's over 2,000 investment bankers across the various countries. And so in the United States, since the United States makes up nearly 50% of all M&A and capital markets activities, we get a pretty good look being here, pretty good look at what's going on around the world and where people are looking to put money or expand. And certainly from my vantage point, the U.S. continues to be the most attractive spot. I think people outside the United States still see this as a stable country, a place where they can invest. And while the outcome may not be known, the rules which everyone's playing by are. And there's something to be said in uncertain economic times for, a level playing field. People understand the rules, in a market that, despite the downturn, kind of the global downturn, the U.S. did pretty well. In the survey, I think you saw, 56% of the participants expected the M&A to increase in the U.S. the most. Kind of Europe and China following there. But North America is still the predominant place, and in terms of outbound versus inbound that we're seeing within my practice, there's clearly significantly more inbound than outbound activity. We're seeing it kind of globally too. So if you look at Europe, this doesn't really apply to China as much, but if you look at Europe, there was definitely a retreat over the last year to pull your assets back and invest locally, right? So if that's Western Europe, invest in Western Europe. Right. So clearly, China, there's still a real drive externally, and especially towards the United States. In the U.S., I think there's more willingness to move more broadly, but I think people still see a lot of opportunity because of the. Right, if they weren't as active in the last few years, they probably have acquisitions or opportunities for growing their business that they might have put on hold that now they'll take a look at. And a lot of times the ones that they'll go to first are the ones that are closer to home that they feel are a safer bet, if not a better bet. At KPMG, we're seeing the seeds already planted for 2014 activity. And I think the numbers in the survey that we put out kind of, foot, for lack of a better term, to what we're seeing in practice. Our M&A practice across the board, whether it be diligence, advisory to the investment banking side, is seeing significant increase in requests for assistance. And frankly, I think it all foots. And so, what we put out in the M&A survey report is tying to what we're seeing internally. And as you know, the M&A process on any given deal may take anywhere from 3 months to 12 months. And so if you're expecting to see a rebound in 2014, you better start seeing the beginnings of it in 2013. And I can tell you that certainly since summer, there's been a tremendous amount of growth in terms of companies reaching out to us and looking for assistance.
Be sure to check back for future editions of the President and CEO Focus on the Middle Market podcast series. Thanks for listening.